You just found it. The boat. The one you've been dreaming about for years. The lines are perfect, the teak is glowing, and the price? It's almost too good to be true. You're already picturing the sunsets in the Abacos and the quiet mornings at anchor. But before you wire that deposit, there is a cold, hard reality you need to face. In today's market, that dream boat might be a financial landmine that no insurance company on earth will touch. If you can't insure it, you can't dock it at a marina, you can't finance it, and you certainly can't protect your life savings if things go south. Today, we're breaking down why your dream boat might actually be an insurance nightmare. We're going deep into the blacklisted models, the hidden 20-year cliff, and the bureaucratic traps that turn beautiful vessels into concrete coffins. If you want to stay ahead of the curve and avoid the pitfalls that catch most buyers off guard, make sure to subscribe to the channel and hit the notification bell. We're diving deep into the technical, the financial, and the structural secrets of the maritime world every week. Now, let's get into the actuarial reality of 2026. The macroeconomic shift, why your dream boat is suddenly uninsurable. To understand why your dream boat is suddenly uninsurable, you have to look at the global stage. For decades, we lived in a soft marine insurance market. Back then, there was too much capital chasing too few boats. Underwriters were aggressive, competition was fierce, and if you had an aging boat or zero experience, someone would still write you a policy for a reasonable premium. That era is dead. We are now firmly in a hard market, a correction driven by a perfect storm of catastrophic losses, skyrocketing inflation, and pressure from the reinsurance sector. Think of reinsurance as insurance for insurance companies. These global entities, the ones that back up the brands you know, have been absolutely hammered. Over the last decade, named windstorms like Hurricanes Ian, Irma, and Maria didn't just damage a few boats, they wiped out entire geographic sectors of the recreational fleet. When a single storm causes over tens of billions in losses, the reinsurers stop playing games. They've imposed strict capacity limits, forcing consumer-facing insurance brands to purge their portfolios. In 2026, an underwriter doesn't see your 40-year-old classic as a beautiful piece of history. They see it as a statistical probability of a total loss. To mitigate this, they've shifted the burden to you. While a standard deductible used to be 1 or 2%, named storm deductibles now range from 5 to a staggering 20%. If you have a $200,000 yacht, you are effectively self-insuring the first $40,000 of damage. If you haven't factored that into your budget, you don't actually own the boat. The risk owns you. The age factor, crossing the 20-year cliff. In the eyes of an insurance company, age isn't a badge of honor, it's a proxy for degradation. This has led to the 20-year cliff. Once a vessel hits 2 decades of age, the rules of the game change overnight. First, there is the mandatory survey requirement. For any boat over 20 to 25 years old, insurers will almost universally demand a recent condition and valuation survey from an accredited SAMS or NAMS surveyor. But here is the survey trap. In a soft market, you could have a few recommendations and still get coverage. Today, those recommendations are treated as mandatory requirements. Imagine you find a 30-year-old boat for $40,000. The surveyor notes that the standing rigging is original, over 20 years old, and recommends replacement. The insurer then refuses to bind coverage until that rigging is replaced. Now you're in a catch-22. You can't get the insurance to satisfy the marina or the lender without doing the work, but you can't or shouldn't do the work until you actually own the boat. This kills thousands of deals every year, leaving buyers stranded. Even if you get past the survey, you have to deal with the depreciation trap. There is a massive difference between agreed value for a total loss and how the company handles partial losses. As the fleet ages, insurers have tightened these terms. We're seeing the rise of the 10% rule. Some policies now reduce the payout for damage by 10% for every year the boat is past 20 years of age. If you're sailing a 40-year-old classic and you have a claim, the insurer might only pay 20 or 30% of the repair bill. They're also accelerating soft goods depreciation. Canvas, sails, and cushions used to be covered for 20 years, but now many policies start depreciating them after just 6. The same goes for machinery. Engines and generators that used to be safe for 20 years are now seeing heavy depreciation applied starting in year 11. You might be paying for comprehensive coverage, but in reality, you are self-insuring the vast majority of your repair risks. The material death sentences. While fiberglass is the gold standard for insurability, other materials are often met with an immediate no. Ferro-cement, the concrete coffin. If there is one term that makes an underwriter hang up the phone, it's ferro-cement. Built from a steel wire armature plastered with cement, these boats had a boom in the 1970s. Today, they are considered financial toxicity. The problem is threefold. First, construction quality varies wildly.
Most were built by amateurs in backyards with zero quality control. Second, there is the invisible killer, armature corrosion. If water reaches that steel reinforcement, the steel rusts, expands, and spalls the concrete from the inside out. You can't see it without destructive testing. Finally, their resale value is abysmal. Because they are so hard to sell, few boatyards will even allow them to be hauled out for maintenance. If you buy a ferro boat, you are likely buying a vessel you can never insure, never finance, and never sell. Wood, the high-maintenance risk. Wooden boats are beautiful, but they represent a high-frequency risk profile. Wood is organic, it rots, and it's susceptible to marine borers. Insurers know that maintaining a wooden hull requires a level of stewardship that the average owner simply doesn't have. Furthermore, the skill gap is widening. Repairing a wooden hull requires traditional shipwright skills that are becoming extinct. This drives up labor costs to the point where even a minor accident becomes a total loss. Unless you're in a specialized classic boat program and have a pristine hull, insurance will be a constant, expensive uphill battle. Cored fiberglass, the compost hull. Modern boats often use a core, usually balsa wood or foam, sandwiched between fiberglass layers. It's light and stiff, but if water gets in through a poorly sealed through hull or deck fitting, the balsa turns into compost. Repairing a saturated core is a nightmare. It involves peeling the outer skin, digging out the rot, and reglassing the entire area. We're talking $300 to $800 per square foot. If a pre-purchase survey shows high moisture in a cored hull, the insurer will deny coverage until it's fixed. Since the repair often costs more than the boat is worth, a wet cored boat is effectively a total loss before you even buy it. Steel hulls, corrosion from within. Steel is tough, but it suffers from wasting. The hull plate corrodes from the inside out, often in hidden spots like under fuel tanks or behind insulation where condensation collects. For older steel hulls, insurers require audio gauging, ultrasonic thickness testing. If the plating is thinned by more than 25%, you're looking at a massive replating job. It's a hazardous, expensive hot work process that most recreational owners aren't prepared for. The secret blacklist. Models to avoid. Marine insurers have massive databases of claims history. They know which boats are lemons before you do. While they won't give you a printed list, certain models will trigger an automatic decline. The Valiant 40 and the Pox. The Valiant 40 is a legendary Bluewater cruiser, but many hulls built between 1976 and 1981 are famous for the Pox.
This was a structural blistering issue caused by a fire-retardant resin that didn't cure properly. These aren't just cosmetic blisters, they are deep delaminations that compromise the hull. If you apply for insurance on one of these Pox-era Valiants, expect an immediate denial or a specific exclusion that leaves you responsible for a $30,000 hull repair. Taiwanese trawlers and black iron tanks. The trawler lifestyle is a dream for many, especially boats from the 70s and 80s like Marine Trader or CHB. But these boats have a ticking time bomb: black iron fuel tanks. These mild steel tanks were often buried deep in the bilge before the decks were even put on. After 40 years of condensation, they corrode. When they leak, you have a massive environmental hazard and a fire risk. To replace them, you often have to cut holes in the side of the boat or pull the engines. Insurers know this. They will demand a visual inspection of every tank face, which is often physically impossible, or they will exclude all fuel spill liability. Houseboats and aluminum wiring. Houseboats, like the Gibson models, face unique scrutiny. Many utilized aluminum wiring, which is a massive fire risk due to oxidation at the connections. In 2026, an insurer will likely demand a complete rewire to copper, a project that requires ripping out wall panels before they will even consider a policy. Additionally, many insurers simply won't write houseboats because they don't fit the standard yacht definition. They're too risky for homeowners insurance and not seaworthy enough for marine policies. High-performance velocity hurdles. If your dream boat can go over 60 or 70 miles per hour, you aren't looking for a standard policy. Speedboats like cigarettes or DCB catamarans require a captain resume. Insurers don't care if you took a weekend safety course. They want to see documented hours on high-power horsepower hulls. Without that experience, you might be required to hire a professional captain just to operate your own boat. Operational restrictions, the hidden policy limits. Let's say you find a boat that passes the age and material tests. You're not out of the woods yet. The policy itself may contain warranties, rules that, if broken, void your coverage instantly. The hurricane box. Insurers manage their risk by defining where your boat can be during hurricane season, typically June through November. This box usually spans from 10 degrees north to 30.5 degrees north, roughly from Grenada up to the Florida-Georgia border. If your boat is in this zone during a named storm, you might be completely uncovered, or your deductible might jump to 20%. This forces cruisers to migrate north or south every summer, a logistical and financial challenge many new buyers ignore. If you want to stay in Florida year-round, you have to submit a formal hurricane plan and pay a massive premium. Captain warranties and sea service. For larger yachts, usually over 50 feet, or for owners moving up significantly in size, insurers impose captain warranties. This means a licensed professional must be in command at all times. To get this removed, you have to hire a training captain to sign off on your competence. We're talking about 50-plus hours of documented docking, navigation, and systems management. If you operate the boat solo before that sign-off, you are essentially uninsured. The Bluewater gap. Many dream of a circumnavigation, but most standard policies are coastal only, restricted to 100 miles offshore. Getting Bluewater coverage for an ocean crossing is incredibly difficult in today's market. Insurers like Pantaenius have tightened their rules, often refusing older boats or crews without documented offshore experience. Furthermore, they almost always demand a full rigging inspection for any mast older than 10 years. If the rig fails, you're looking at a $20,000 unplanned expense before you can even leave the coast. The bureaucratic nightmares, titles and HINs. Sometimes it's not the boat's condition that kills the deal, it's the paperwork. The hull identification number trap. Since 1972, every boat must have a unique 12-digit HIN. But home-built boats, older vessels, or gray market imports often lack them. Without a valid HIN, you can't title the boat. Without a title, you can't get insurance. If you buy a boat in HIN limbo, you are entering a world of police inspections, USGC affidavits, and months of waiting. The salvage title stigma. A boat that was declared a total loss due to fire or sinking might look like a bargain at an auction, but major insurers will almost never touch a boat with a salvage or branded title.
The risk of hidden structural fatigue or electrical corrosion is just too high. At best, you might get liability-only coverage. This means if the boat sinks again, you get zero. This also kills the resale value. It becomes a forever boat because no one else can finance or insure it. The grandfather illusion. This is the most common mistake buyers make. They see that the current owner has a policy with a major carrier and assume they can just take it over. This is a myth. Insurance policies are not transferable. When the boat is sold, the old policy is canceled. Your application is a new business. The carrier might have kept the old owner because they'd been with them for 20 years, but they will reject you because the boat is now over their age limit. Never, ever rely on the seller's insurance status. The claims nightmare, when coverage fails. Even with a policy, your dream boat can become a nightmare during a claim because of how the fine print is written. One of the most dangerous terms is the consequential damage exclusion. Standard policies cover accidental direct physical loss, but they exclude wear and tear. Imagine a $20 hose clamp corrodes and fails. The hose pops off and the boat sinks. If your policy lacks consequential damage coverage, the insurer will deny the entire claim. They'll argue that because the cause, the corroded clamp, was a maintenance failure, the resulting sinking is not covered. You must ensure your policy covers the resulting loss, even if the failed part is excluded. Then there is the wreck removal gap. If your boat sinks in a channel, you are legally required to remove it. Some cheap policies limit wreck removal to a small percentage of the hull value. If your $10,000 boat sinks and costs $15,000 to raise, a bad policy might only pay $1,000, leaving you with a $14,000 bill. A proper yacht policy should provide wreck removal up to the full liability limit, independent of the hull's value. Strategies for the modern boat buyer. The era of casual boat ownership is over. In 2026, the seaworthiness of a vessel is inextricably linked to its paperwork and its actuarial profile. If you want to avoid an insurance nightmare, follow these 5 strategies. 1. Insurance as a precondition. Treat insurability as a go, no-go gate. Before you pay for a survey, get a binding insurance quote. Do not wait until the end of the deal. 2. Budget for the hidden costs. When you see a 40-year-old boat, immediately budget for a full rigging replacement, new below-waterline hoses, and a potential rewire. The insurer will likely demand it anyway. 3. Avoid the blacklist. Unless you have the cash to self-insure, stay away from ferro-cement, older steel, and boats with original black iron tanks. 4. Scrutinize the depreciation. Read the partial loss clauses. If the policy depreciates hard goods after 20 years, understand that you are effectively uninsured for major repairs like a dismasting or an engine failure. 5. Maintain the paper trail. Keep every receipt. In the event of a claim, being able to prove that a failed part was recently replaced can be the difference between a full payout and a denial based on wear and tear. Navigating the waters of boat ownership requires a shift in mindset, from romantic optimist to risk-aware realist.
A boat that cannot be insured is a boat that cannot be used.